Major funding for these programs is made possible by grants from Capital One Bank and Perfect Building Maintenance, Murray Hill Properties, SJP Properties, Cushman & Wakefield, Greenberg Traurig, LLP, New York Community Bank, Bank of America. Additional funding for these programs is made possible by grants from Akron Gold Brothers, LLC, C.B. Richard Ellis, City Investment Fund, Essex Capital Partners, XL Realty Advisors, First American Title Insurance Company of New York, Gemini Real Estate Advisors, GVA Williams, Hal Fettner, Durst Fettner Residential, Helmsley Spear, Herrick Feinstein, LLP, Jackson Development Group, James D. Kuhn Real Estate Institute at Syracuse University, James Orphanides, John Katzimatidis, Kilroy Metal Products, New York's Window Company, M&T Bank, Madison Realty Capital, Marcus and Millichap, Massey Knackle Realty Services, Meridian Capital Group, Muss Development, Newmark Knight Frank, Palin Enterprises, Rosenthal and Rosenthal, Sheldrake Organization, Signature Bank, Sterling and Sterling, Stephen Napolitano, Stonehenge Partners, Studley, the Moynihan Group.
Hello, my name is Michael Stoller. 2008 was a year that everyone in the real estate industry would like to forget. So how is 2009 going to be? I don't know. I take my apple, I try to shine it up, but I still have no idea of what 2009 is going to look like. So today, in a special edition of the Stoller Report, I brought together two of the leading prominent guys in the industry to discuss their views of what 2009. My guests today include a frequent guest, who's been on the McLaughlin Report, my friend Bruce Mosler, who is the president and CEO of Cushman & Wakefield, and his colleague in crime, John Santora, president, CEO of Cushman & Wakefield for the United States. Thank you for coming here today.
Thanks for having us, Michael.
So, Bruce, you've been with me 7 years, 8 years in different levels of concern. So how do you, 2001 we joined together on the first show. Now we're in 2009. So what do you look like? Of over the years, where does 2008 compare to those past 7 years that we've been together?
Well, the first thing I'd say is that we've had a good run, right? So 2008 to some extent was inevitable, and 2008 was just as challenging as any other downturn that we've been in, if in fact maybe more so. Tough year, and I think we would say, looking forward, that 2009, certainly the first half, first couple of quarters in particular, are going to be as great a challenge or more so than any other year in which we've been doing business.
So, John, how was 2008 on a national exposure for Cushman? With regard to leasing, with regard to investment sales, with regard to all the aspects of the company runs?
Well, Michael, we saw investment sales drop somewhere around 65 to 70%. The national average was down a little bit more than that, so I think we held our own in a market where very little product traded. On a leasing basis, we're down overall about between 12 and 15%. Market by market, it's very different. As we've discussed, the Southern California market was down significantly, while markets like Houston, Denver, and and Washington, D.C. actually had pretty strong years.
And what about this region? New York, New Jersey, Connecticut. How was that for the company?
New York kind of held its own, probably off about 10%, a little less than 10%. We'll know when the December numbers finally do come in. Jersey down a little bit more than that. Connecticut was probably around the same.
With regard to investment sales in this region, because even though nationally a large number of the investment sales in the U.S. really come out of the New York market.
Sure.
Would you agree?
Of course, I think we would agree with that, but I think John's point is that despite the financial institutions' challenges this year, that the market still held its own. Clearly volume was off, and clearly we face some extraordinary challenges going forward. Institutions, financial institutions in particular, are cutting back. That's no surprise. We're going to see the same after the first of the year. We'll continue to see employment drop in New York. And on a go-forward basis, I think that we're going to see some other challenges to the market and to the industry, particularly as we discussed before the show in the hedge fund arena. That has been perpetuating.
Let's look at the layoffs. You know, the other day I was watching the CNBC report, which said, they really said basically we don't want to remember 2008. There were so many incidents and other occasions that took place. But, you know, if we just take our local market, by the beginning of 2009, we can have 250,000 layoffs in New York City. And now we have this other fiasco, the Bernie Madoff situation that we discussed before, which nobody, you know, no one has really brought that up in the right respect for real estate. You know, there was an article in the New York Times talking about how it's going to hurt people. But it didn't really discuss how it's going to affect the commercial and the residential market. Now, you have a very successful and good business in Fairfield in the Stamford area, and a large number of those office space was occupied by hedge funds and companies that had services to hedge funds. With 1/3 of the hedge funds already closing down and redemptions coming on a daily basis, I mean, what do you see going to happen in Stamford and Greenwich?
No, I think you'll see, obviously, some more subleasing. Some of the hedge funds will cut back on the space that they have today. Some will not be around tomorrow. We know that. There's a fair amount of them that will not survive this. I don't think it's this one incident. Yes, this is on top of, you know, their funds being down, you know, an average of 30%.
Right, but I think...
But let's also, Michael, put some perspective on this. Clearly, hedge funds have been challenged, but there are also hedge funds that are run well, that provide an excellent return to their investors. Those folks are going to survive. The cream of the crop always rises, and let's make sure we don't lump everybody together during this most challenging
I'm not only bringing
period.
up hedge funds when I talk about Fairfield and Stamford.
Sure.
I mean, I'm talking about foreign banks. I mean, if you think it's difficult to lend in America, it's next to impossible to get financing in Europe. I mean, today there was an article in the Journal talking about the 3 leading banks in Ireland being bailed out by their government for about $4 billion. You take banks, they came to New York, they came to Stamford, they came to Manhattan. You know, Anglo-Irish is a very big bank. They were lending, one of the major lenders for commercial real estate. A lot of the properties that your organization sold were financed by that. Sure. What effect do you see this European exposure, the entire falling of all these things, having an effect on the leasing market in the New York area for 2009?
Michael, I think we look at 2009 and we say, not to state the obvious, but clearly we're going to see business, global financial business, challenged. The challenge is not short-term, it's long-term. We expect business to cut back, but we also expect those businesses where there are lease rollovers to continue to look at the opportunity to renew. So we expect 2009 to have renewals. We expect those folks who are in the market to be able to perhaps trade up an asset class. There are opportunities even amongst the challenges, and clearly we expect the shadow space of the sublease market to continue to grow. It's about 30% of the overall market today. We project that that might increase by as much as 10 or 15%, and we expect rents to fall, but maybe not as precipitously as some people would say.
So, with regard to rents falling, you know, last week I moderated a panel at the real estate board,
yes,
and I had a number of your colleagues from other firms, and the discussion took place not with regard to the hedge funds, just with regard to the economy, that they were saying that they could foresee in 2009 office rents on Park Avenue to go as low as $60 to $70 a foot. Do you think it can happen, John?
Absolutely. I think we're starting to see it now in some of the sublease space, and the direct space will follow behind that. I don't think it's going to do much lower than that, but I think there's an opportunity for those who have their leases rolling over or have a short time left in the leases to get for high quality space for a long term at a very good rate.
I mean, you know, with a recent...
So there's the opportunity in a down market.
We recently had this law firm, Dreyer & Company, representing 8 floors at 499 Park Avenue. That's 88,000 square feet out of a Class A building. Today, Thatcher Profit is probably going to go out of business, who's in Lower Manhattan. So, you know, this effect is having an effect all over. It's not only hedge funds, it's just layoffs and all this employment. So where do you see, within the city and the different markets that we have, where do you see the greatest reduction in rents and the greatest opportunity for a tenant in case they want to lease space in New York next year?
I think there's going to be some, I know that there will be some big blocks of sublease space available, some of that with long-term on it, some of it recently built out, so the space could be almost move-in condition with some minor changes. I think that's a great opportunity for someone looking for a longer-term big block of space. Overall, all the markets, all the sub-markets will be down. Markets hit worse will probably be the downtown market. If you look historically, downtown suffers more in a downturn than Midtown does, but overall we're going to have some pain across the board.
Yeah, and again, just to add to what John said, I think we've got to keep some perspective on this. I think first half of next year is going to be significantly challenged, and I want to tie it directly back to employment, because employment is important. It is what drives the market stature and health, and I think when we get through the first half, Michael, and the economy starts to grow again, and I may be an optimist, some would say eternal optimist, but I do think that there's opportunity in the second half of the year.
Dr. Gloom.
Well, but I'll tell you why. Value propositions, let's move to the investment sales side of the equation for just a moment. The value proposition will reconcile in the second half of the year. There will be product that institutions decide to move to the market, and cap rate compression, which for years had brought us perhaps to an unrealistic low level, is going to adjust. And when it adjusts, it won't adjust from threes and fours to fives and sixes. It'll probably adjust in a harder fashion, perhaps to 6 and 7s or 7 and 8s. That's an opportunity. When you begin to see cap rates rise like that, New York in particular and the region will become a very attractive investment for foreign investors and indeed for some local investors.
So you, as opposed to a lot of the industry leaders and economists, you believe that maybe in the middle of 2009, the economy is going to recover and we're going to have a different marketplace.
I think more towards the end of 2009. The optimistic view, Michael, and I hold the view, and I hold it with some degree of concern, that the third and fourth quarters next year may be better than we think, because the government will invest significant capital into the system. That may indeed help perpetuate a recovery. Whether the recovery happens in the last quarter or the first quarter of 2010, I think that the second half of 2009 won't be quite as bad as some of the economists predict. And I think that's because once we see the bottom and we begin to bounce along the bottom, we are at the stage of a point in time where panic subsides and optimism returns. This market is a market that very much goes on perception.
Cushman & Wakefield is the largest private real estate company in the world.
Services, yes.
Services in the world. There are a number of publicly held companies who have seen some difficult times. Their stock has been shattered.
What do you think he's going to ask us, John?
No, you don't know. You know, I never give you the questions up front. My question is, but you had a change of ownership about 2 years ago.
Yes.
I mean, the employees of the firm own a portion of the company,
yes,
but about 60% of the company is owned by 72% of the company,
yes,
from an Italian company who, yes, owns Fiat and some other things. How do you look at the market in 2009 for the publicly held companies, and how do you see a falling out on that market? Do you see a merging? I mean, you bought a company in San Diego last year. You know, you've always made very good strategic moves. In 2006, you went out and bought Sonnenberg Goldman, so you took the majority of Cushman & Wakefield, Sonnenberg Goldman. Where do you see the market changing in 2009? What opportunities are going to be there for a company who really doesn't have much debt and who's well postured like you guys?
Well, the first comment I'd make is that globally, for those businesses like Cushman & Wakefield that are global businesses, we're going to all face challenges. And from an operating perspective, I don't see there being a big difference between ourselves and our competitors in this arena. Where we do believe we have some advantages is, as you mentioned before, in having a low level of long-term debt. We are going to be able to adjust our business model for the current moment in time in which we are. We see opportunity all over. I think for John, who operates the entire Americas, we're looking at local businesses that can contribute to the Cushman & Wakefield platform. particularly in our corporate services business. We think that there will be more outsourcing by the institutions, and that a business with the kind of platform that we have will be attractive to those institutions. On a global level, we're looking at opportunity to grow in Europe and Asia. We think that some of the businesses in that particular market are challenged, and that they may see the benefits in a global business like Cushman & Wakefield.
When we talk about America, John, are we talking about all of North America?
No, all of the Americas,
so we're talking
from
about
Canada down to
That's right.
Brazil.
And Brazil. So let's really, a lot of people were focusing, Canada has done better, they say, over the last year than America in this economic times. And Mexico had done well, but now it's seeing some crises over there. How do you look at those markets, the Mexico and the Canadian market today?
Actually, Michael, Canada has not done significantly better than the U.S. markets. In fact, many of their markets have been hit as hard, if not harder, than our markets here in the States. A couple of markets that are driven by oil and energy obviously have done well, as the oil and energy markets in the States have done well. When you move to Mexico, Mexico's market was a very good year in Mexico for our company and for that market. Space became available. The last couple of years, there was very little space available in that market, and with the devaluation of the peso, more dollars come into that market, and because of the labor rate exchange. So that market was pretty good for us this year, and I think overall in the real estate industry. The other market that had a fabulous year was the market in Brazil. In and around Sao Paulo, about 20–25% growth in that market for us, and for much of the real estate. So there has been certainly some bright spots for us during 2008.
One area that has definitely been challenged in 2008 is retail. I mean, Cushman & Wakefield has a great retail organization. I mean, you've been responsible for the changing of, like, in Columbus Circle at 15 CPW, you put West Elm in over there, and at 666, Abercrombie is paying probably one of the highest rents ever to be seen.
Don't forget H&M at 645th was
Okay,
a Cushman & Wakefield deal from our European
I'm talking
partners.
about this year. I'm talking about this
sorry,
year.
I just...
Okay, but how do you see the challenging effect on retail? Because retail is definitely going to be challenged. We walk down Fifth Avenue, we walk down Madison, and if we walk down the other blocks, the world is changing. How do you see retail?
Yeah, I think without question, 8 has been a challenge for retail. I think 2009 will be a greater challenge for retail. For our clients, it's going to come down to being in the right location, the right product. It's going to be tightening up in those markets where they're going to get hit harder. I think the malls are really going to get hit very hard, and we're seeing that, and we're seeing the problems with ownerships in the malls now. But your high streets around the world will continue to be down, but not down as significant as the local markets, the strip malls, and the regional malls.
Yeah, I agree with John, because the high street markets represent brand recognition, and for retailers, that's the lifeblood. So I think they're going to continue to invest in the core marketplaces, and I think, in fact, some of them will see it as an opportunity to pick up great locations at perhaps some reduced pricing.
But in reality, over the years, many retailers, as you say, they were branded locations. People wanted to be on Madison and Fifth Avenue, not because the amount of retail sales, but to show that exposure in that type of location. But the question comes in, and this relates to the commercial and the retail. At the beginning of 2008, AIG was a credit tenant. Bear Stearns was a credit tenant. The question is, what's going to be a credit tenant, and how is this going to have an effect on investment sales, and also how is it going to have an effect on the landlord saying, that was a credit tenant, I want a credit tenant, and for me to get financing, I need a credit tenant, but who knows what's a credit tenant today?
Well, Michael, I think this is going to be, in fact, one of the hardest component parts of our business is to determine what credit looks like. What's a good credit, as you mentioned? It's going to require further review and due diligence by landlords. It's not going to be Googling a tenant. It's not going to be just looking at their balance sheet. It's going to be asking questions about the future condition of their business. It's going to be harder because in the past, credit was really a reflection of your past performance, and today, credit really is going to have to reflect how's your business positioned for future business in the industry. So tougher questions are going to get asked. It's going to be a much more I think, arduous process when you come particularly to the investment sales side of the equation and you look to pro forma an asset. You're going to have to go through a building line by line to really determine the health and structure of that asset. So it's going to be a much more, I think, drawn-out process to a certain extent, and therefore there will be a limitation on the overall volume of deals. But nevertheless, I believe that the latter half of '09 is going to produce deals as the value proposition is forced to reconcile.
Both of you were around in the early 90s when there were companies who went out of business. Names, many names were, went out of business. I mean, there was fear, that some of the REITs would have gone out of business this year, and there are fear that certain of these highly leveraged borrowers who may have bought things may go out of business. We were talking about it before. What's your thoughts about the recovery, the government's possible help in the commercial mortgage market, because there are loans coming due. And many of these loans were interest-only loans, and what's even worse about these loans were predicated on future rents. They were the loans were made with the expectation that the rents were going to go up, and now the rents, as opposed to going up, are going down. So where do you see that happening?
I think there's a number of properties that continue to perform, continue to stay up to date on their payments and on their debt covenants. So I think the challenge is going to be, as they come due, the lack of capital being available for some of these big mortgages. So we're gonna hope, and we're starting to see now the banks extending that balloon payment out another year or 2 years. They don't want to take the property back. So if the
unfortunately, John, the problem is not even the banks.
Yeah.
The question is we don't know who it is.
Yeah.
Because if it's a terrible collateralized mortgage debt, there are different tranches. It's like where is the bottom of the apple over here?
No, just in some cases, Michael, I think you're right. It's a challenge just to know where the debt really lies. But in other instances, it's not that significant a challenge. We do have a liquidity lockup problem. And the government has to put some additional pressure on the institutions to put money out into the field. We have about $400 billion of mortgages rolling over. Not a great deal of those mortgages are troubled when you look at it on a percentage basis. A number of them are performing. And we have to have the ability, the institutions have to find a way, and as John said, they are beginning to find a way to extend those loans so that we can get into a different arena where the value propositions aren't at the low point, but perhaps at a more balanced place. We've got to do that in order to keep the commercial business and industry as a whole healthy.
I think a lot of the mortgages are really going to take place in 2010, but I want to now focus a question into the other, okay? The good thing that happened is we didn't have that much expansion, so we don't have, as in the 90s, we had a lot of vacant offices over there.
And even
today,
to your point.
Okay, today we have, 11 Times Square, which I'm certain with Prudential and Steve Pizicki will be leased. We have the Boston property on 56th Street and 8th Avenue. They already have a good number of tenants. I think we have a little problem with 510 Madison and 545 because right now they don't have too many tenants over there and they were built for hedge funds. What about Lower Manhattan, the World Trade Center site, and the Hudson Yards? Any thoughts?
I think the Hudson Yards is going to be off for a little while. I don't see anything starting there for a period of time until this market starts to turn around. You've got $1 billion or $1.5 billion in infrastructure or platform just to start off. So my view is that's going to be out for a little while before that happens. I think downtown at the World Trade Center, and there's going to be some dragging the feet before that comes up. There's going to need to be some significant tenants before they continue, but yet there is a challenge on payments between the Port and Silverstein and so forth.
I have a little different view than my partner. I think that Hudson Yards has locationally some advantages, and I think that the commercial part and component part of that isn't what's driving the overall development project. And I think that the developer there could be fairly aggressive in terms of pursuing a commercial tenant. I would also say this about downtown. For a long time, a number of us have been saying we don't need all of that square footage. Well, as it comes to pass, we clearly don't need all of it, and so I think choices will get made. Some of that product can get absorbed, but I think the storyline is too early to tell or write for downtown at this point. There are clearly some key deals that are going to transpire or not transpire, and that will impact downtown overall. There's some vacancy opportunity there today where tenants can, from an economic perspective, really drive an outstanding deal. And let's not forget that there's always been somewhere in the range of $15 to $20+ in disparity between Midtown at the height and downtown as well. Right now, downtown vacancy doesn't look too bad, but there's some key deals that have to.
Right. It doesn't look that bad, but if you take into consideration AIG's 2.8 million square feet, Merrill Lynch's 3.5 million square feet, and then the fact that Goldman Sachs is going to move from one building to all their other buildings, that's 8.8 million square feet. And now you have Thatcher, you have other companies in a situation where we're in a circumstance. What about New Jersey? New Jersey was thriving.
Yep.
Jersey City, you've done a lot of business, done a lot of leasing, you've done investment sales. What do you see happening in Jersey City and Hoboken?
I think you'll continue. I mean, look, there'll be a great challenge there. I mean, it's obviously the overflow space that happens, but I think firms will continue to try and be cost effective and look to have their back office space continue to move outside of the major cities, or certainly here in Manhattan, to conserve, to get lower rent and get the play on labor costs as well. So I think you'll still see some of that. Obviously, it's not going to thrive as it has in the past 4 or 5 years, but you'll still see some deals get done.
So with like 30 seconds left, Bruce, where do you take your crystal ball? What do you see the best of the apple for 2009?
Let's start with the leasing side of the equation. I think that looking towards 2009, we are going to see activity. It will mainly be based on lease rollover, renewal opportunities, the ability to trade up in asset class for some businesses, the ability to take advantage of downtown rents, where I think the disparity will probably be even greater between Midtown and downtown from a historical perspective. Again, opportunity is what I see on the leasing side. From the investment sales side of the equation, I think that you will see in the latter half of the year, closer to the third or fourth quarter, you will see investment sales assets trade at a new value proposition. That's going to make New York, and in fact, I think this country, attractive on an overall investment basis as foreign capital looks to disperse and invest around the world. We are going to be an attractive alternative. So yes, there are huge challenges, beginning with unemployment, but it will probably be the year in which I think we see the bottom, and the year in which we see value propositions from a property level reconcile.
John, quickly on the national exposure.
On a national basis, I think you'll see some opportunities where people will begin to move back in the markets at the tail end of 09 or beginning of 010, take advantage of lower prices, lower rates. I think we're going to, unless something happens with oil, I think Houston and Denver will become a little challenged, like the other markets have. But I do think there's some great opportunities around the country in some of these markets, but it is without question going to be a challenge.
So I'm going to take my apple, I'm going to try to polish it, and I hope that my good friends Bruce and John are correct, and 2009 is much brighter than 2008. I'd like to thank you, and I'll see you next week.
Thank you for having us, Michael.
Major funding for these programs is made possible by grants from Capital One Bank and Perfect Building Maintenance, Murray Hill Properties, SJP Properties, Cushman & Wakefield, Greenberg Traurig, LLP, New York Community Bank, Bank of America. Additional funding for these programs is made possible by grants from Akron Gold Brothers, LLC, C.B. Richard Ellis, City Investment Fund, Essex Capital Partners, XL Realty Advisors, First American Title Insurance Company of New York, Gemini Real Estate Advisors, GVA Williams, Hal Fettner, Durst Fettner Residential, Helmsley Spear, Herrick Feinstein, LLP, Jackson Development Group, James D. Kuhn Real Estate Institute at Syracuse University, James Orphanides, John Katzimatidis, Kilroy Metal Products, New York's Window Company, M&T Bank, Madison Realty Capital, Marcus and Millichap, Massey Knackle Realty Services, Meridian Capital Group, Muss Development, Newmark Knight Frank, Palin Enterprises, Rosenthal and Rosenthal, Sheldrake Organization, Signature Bank, Sterling and Sterling, Stephen Napolitano, Stonehenge Partners, Studley, the Moynihan Group.